Good afternoon. You're watching Business World Live. I'm Jes Delos Santos. Let's take a look at how the local bourse closed today, Friday. All right, so we're capping off the week on a high. The index recovering from early trade losses to end the day above 7,000 once again, despite, of course, January inflation clip quickening to its fastest pace in 2 years. Local shares still soared 1.7% to 7,019.18. The PSEI, in fact, is Asia's best performer for the day. That's after taking a 0.9% dive after, again, January inflation picked up to 4.2%, exceeding Bloomberg estimates of 3.5% and BSP expectations of 3.3 to 4.1%. That uptick attributed mainly to increasing costs of food and drink, specifically vegetables and meat. The central bank managing fears somehow, at the same time boosting investor confidence here, resulting again to that climb that we're seeing in local shares here. You have BSP Governor Ben Diokno believing that inflation will settle still within the 2 to 4% target over the policy horizon. Diokno says it's all due to shocks in the supply side. He says it's going to be temporary and does not require policy action unless there are second round effects. He adds, such pressures are better addressed by non-monetary actions like ramping up supply. Some analysts believe, that this signals an end to the BSP's easing. The central bank says this will, of course, factor in come their February 11 meeting. The peso earlier in the day dropped to its lowest level in over a week here, but managed to somehow end the day, at least as try to take a look at this chart here, still looking and change their price in at 48 pesos to the greenback here following that inflation print. Back to the bourse, however, a look at our leaders and laggards here. I should try to come up with a chart here. 20 of the 30 members of the main gauge ending the day on a positive note here. Ayala Land and BDO, as well as Ayala Corporation, providing the biggest boost here to the index. As you can see here, Ayala Land edging higher by 2 7/10%. Ayala Corporation, in fact, also in the green here, up close to 3 1/10%, as well as, of course, one of our biggest lenders, BDO here, also on an upside here, up 2 4/10%. SM Prime were some of the heavy laggards earlier, but reversed those dips to end the day as part of our best performer list. Now, let's go over to one more Ayala unit here. I'm talking about AC Energy, as this is the power player, targets to raise 16.4 billion pesos via a follow-on offering of as much as 2 billion primary shares here, which with each share price at 6 pesos to 8 pesos and 20 centavos a piece. The renewable energy player is eyeing 30 billion pesos worth of cash infusion from share sales this 2021. Shares in ASIN today having more muted gains compared to the rest of the bourse. They are up 0.1% to 7 pesos and 22 centavos a piece. Now, here are other headlines we're keeping our eyes on. Malacanang has expressed support on the move to extend the no disconnection policy for lower-income households by 2 more months. Cabinet Secretary Carlo Nograles says the president is backing the so-called lifeline rates for poor households. Palace is also seeking Congress approval to extend this benefit until 2051. In a statement, Energy Department said the president backed other measures to assist poor customers, including the tapping of foreign assistance funds. Meralco Vice President and Head of Corporate Communications, Joseph Daliaga, says they will comply with the government's directive and await specific guidelines from the DOE. Now, the San Miguel-backed MRT-7 is being targeted for partial operations by December this year. The Transportation Department says the train line will operate from North Avenue Station in Quezon City until Sacred Heart Station in Caloocan. The MRT-7 depot along Quirino Highway in Barangay Lagro in QC is also expected to be operational by that time. The 63 billion peso MRT-7 project will run between MRT-3 North Avenue in Quezon City and San Jose del Monte, Bulacan. The 14-station train line is expected to divert northern provincial bus operations to San Jose del Monte to help decongest EDSA. All right, we circle back to our top story with inflation clocking in at its quickest pace in 2 years at 4.2%. Is this a one-off or a sign of things to come? To talk about that and more, we have Sonny Africa, Executive Director of IBON Foundation. Good afternoon, Sir Sonny.
Hi, good afternoon, Jes. How are you doing?
All right, sir. Let's kick things off, of course, with that inflation print to start off the day here. Does this mark a return to trends that we saw back in 2018? Do you see inflation remaining elevated in the near term, or is this temporary, like what BSP Governor Ben Diokno is saying?
Well, definitely some of the shocks driving this recent burst in inflation were seen momentarily, like the typhoons last year. But I think that BSP might be underestimating the invisible supply shock. We have seen thousands of MSMEs collapse. Um, with the pent-up demand, once we're going to be feeling once there's an easing of the quarantine restrictions, we might actually see a bad combination of too much demand for too little supply. I think, and the worst part is actually, if there's one thing that's going to be keeping inflation down, it's the fact that unemployment is at a record high, incomes have collapsed, but that's actually not a good way to keep inflation down, to keep demand down. So I think we could still be in for surprises. And of course, food is always a wild card for us. We never know how much food prices will go up. But one thing we're sure of is that we have a problem with the government de-emphasizing agriculture in 2021. If part of the reason for the price shock in the last years has been for not enough spending on agriculture to increase productivity, we're actually quite worried that the government is spending less actually of its budget this year than in the past 4 years.
Okay, we'll get to those supply side pressures later. But first, I want to ask you how much of a factor, of course, are the low base effects that we had in 2020 to this uptick in inflation, or at least a perceived trend?
2020 was really abnormal. I think a lot of our custom analyses from previous years is going to be going out the window because of the huge pandemic shocks. And I think three major wildcards for 2021. One is that the record unemployment and low incomes, we have to deal with that. Secondly, we probably will be feeling the effect of thousands of MSMEs closing down once demand starts getting felt. And third, actually, the lack of confidence, I think, is always difficult. I mean, the fact that we had lending fall for the first time in 14 years, I think that's not a good sign on the supply side for us. So it's very hard to say, but offhand, we're probably going to be seeing at the very least the high end of government estimates for inflation, maybe even more. I mean, we'll see.
Okay, like what you mentioned earlier, much of it has been attributed to supply side pressures here, both from pork and vegetables, of course, factoring in African swine fever as well as the typhoons last year. Will actions to actually introduce price caps and lower import tariff help temper these price pressures? Are these steps in the right direction?
We're worried if there aren't enough, if there's not going to be enough support to increase productivity in the short term, the price cap may not be actually very useful. It might discourage more producers from producing. If they moderate the supposedly exploitative trader aspect, I think that might help to moderate the prices. But right now, we are of the view, not on a long-term, as a long-term policy, judicious use of imports to fill up the lack of supply, I think, might be called for in the coming months. But again, the best long-term hedge against inflation is high agriculture productivity, and we have to spend for that. That's the bottom line. We have to give more attention to agriculture infrastructure instead of transport and communication infrastructure.
Okay, so in short, of course, more than the stopgap measures, it's really a long-term play here for the government. Moving on from there, Sonny, let's talk about the passage of CREATE. At least that has already been ratified by both houses of Congress. And it's being pegged by authorities as a form of stimulus in response to the pandemic as well. Your thoughts on that?
Well, on the contrary, I think it's a bit unfortunate that our economic managers are packaging it as a stimulus. I think they're just being opportunistic. They've been pushing that since 2018. They've been renaming it. There was never a stimulus package then. it's not going to be a stimulus package now. It's actually, in our view, it's going to be a bit self-destructive for the economy while benefiting big corporations. 3 points. Timing's awful. It's reducing revenues for spending that needs to be done at the worst possible time. As it is, corporate income tax rates are falling as a share of total tax revenues. Create is going to worsen that. Secondly, it's not going to stimulate any COVID response. It might improve the balance sheets of corporations, but a lot of large corporations can actually survive even without the create. And the biggest number of micro, small, and medium enterprises who are in difficulty are actually not formally registered. So you'll have very few MSMEs actually benefiting. And third point, it might actually make debt more unmanageable by being an ineffective stimulus, by in effect dragging growth. That's actually going to make debt more unmanageable down the road. And we are actually quite sure one reason we're borrowing so much this year and next year is because we're going to be losing 150 billion pesos in the coming couple of years. And that's not the kind of thing we should be doing. It's an indulgence that the economy really can't afford right now.
So over 100 billion pesos worth of tax cuts here. But how certain are the perceived gains, at least the ones being promised by authorities from Create?
I think that's exactly the biggest problem. The tax cuts are certain. 133 billion more or less lost is certain. But the gains in terms of will it stimulate investment, that's very unlikely. As long as, for instance, we're feeling the effects of COVID, as long as economic activity is tepid, as long as, for instance, the business confidence is quite low, as evidenced by the collapse in lending recently, putting more money in big business pockets, it's very unlikely that it'll actually have any real stimulative effect. And I think it's actually very sad. Instead of putting money in people's pockets and genuinely stimulating the economy with spending, going to the local economy, this is going to improve balance sheets, but not really stimulate the national economy.
That, of course, Create is being at least paired now, of course, with proposed changes of the Constitution, especially on economic provisions. Do you find that just as untimely as like Create?
I think it's, again, some opportunistic packaging. Even the economic cha-cha by the announcement of Speaker Velasco, if it's for ratification by the May 2022 elections, you're not going to see any effect on actual investment until the years after that. And the thing is, if you don't have a significant expansionary fiscal policy right now, things are going to be much worse. If we're hoping for some investment benefits from cha-cha, again, like Create's investment benefits, that's very uncertain. Let's work with what we have now, address immediate problems to stop the situation from getting worse in the years to come. Economic cha-cha is not going to do anything in terms of recovery.
Okay, and then of course, a number of experts have already said that much of the country's economic recovery would hinge on the government's vaccination program. With the pace things are going, do you see this happening soon?
We don't actually need to put all our chips in the vaccine table. I think other countries in Southeast Asia that have been able to contain the virus with not just mass testing, but proper rational contact tracing and isolation, like Vietnam, they're getting positive growth. So I think even the whole fixation on vaccines might be counterproductive. We should do the proper tracing and isolation now. I think that will give more confidence to people. That will increase economic activity more than waiting for vaccines, which, to be honest, we're buying so late. It's not going to come until in substantial amounts until maybe the end of the year and early next year. And again, the damage will have been done by then. We should act now, I think.
Okay, and not just waiting on the vaccines to arrive, but really working on it now, acting on it now, just like what you mentioned. Thank you very much for your time this afternoon. Sonny Africa, Executive Director of IBON Foundation. Happy weekend, sir.
Thanks, Jes. Happy weekend.
And those are the biggest news this trading day, February 5, 2021. Catch Business World live again Monday next week at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jes Delos Santos. We are One News.